Welcome to the Game Plan Podcast, the show that helps you grow wealth, create passive income, and achieve your financial goals faster. I'm Damodar Mata, author, blogger, and financial advisor in Dubai. This is weekly market update as of 5th December 2021. Tune in every week for news, views, and market moves. Subscribe on YouTube, Apple, or Google Podcasts, or on your favorite podcast app. The title of today's episode is Who Let the Bears Out? Let's dive into the show. Last week, the bears were out in the open, busy pushing the global equity markets down sharply and scaring the bulls to safe havens. Before we discuss how the markets could progress from here, let's discuss who let the bears out first. Was it the advent of the Omicron variant, or the hawkish tone of the Fed, or the year-end portfolio rebalancing and rotation by mutual fund houses? And the following question is, will this sell-off continue, or will the markets recover shortly? Who let the bears out? The markets were on tenterhooks even before the advent of the Omicron variant. Since then, there has been quite a debate on its impact on the economy, causing panic and market volatility. However, health officials indicate that the vaccines could provide some protection, particularly when it comes to severe illness and hospitalizations. According to Dr. Eric Topol, Professor of Molecular Medicine and Executive Vice President of the Scripps Research, quote, "We are better positioned to defend against the Omicron than we would have been earlier in the pandemic," unquote. Please find below the link to his detailed write-up on Guardian in the show notes below. Given that we are already amidst a global pandemic for the last 2 years and we have made significant progress with the vaccination and the treatment of COVID-19, we cannot just attribute the recent correction just to the discovery of the Omicron variant. Let's see what other potential causes could be. Given the strong jobs report and the growing US economy, the Fed's tone has become more hawkish of late, indicating a swifter tapering. In the last week's commentary, the Fed dropped the word transitionary when describing the US inflation. This also added some fuel to the fire. However, in light of the recent setback, a rise in interest rates in 2022 is doubtful, which could bring some relief to the markets. Lastly, the year-end liquidation and rotation by mutual fund houses also contributed significantly to the fall in stock prices. Typically, mutual funds rebalance their portfolio before the year-end by trimming overweight winning positions to buy underweight and relatively cheaper losing positions. Given the above-average returns on many growth stocks this year, rebalancing effects are more pronounced. So, it is difficult to attribute one particular event to last week's market correction. It's more of a medley of sorts like stretched valuations, the Omicron variant threat, hawkish Fed tone, and the year-end rotation and rebalancing by active fund managers. In light of the recent setback, the following question is, will this sell-off continue, or will the markets recover shortly? The chances of a quick recovery are based on the reports of the virulence of the new variant and the efficacy of the vaccines and treatments against it. If this new variant proves to be less potent, this dip could be actually an opportunity for investors to buy. Even otherwise, experts believe that the global recovery can only be delayed and not derailed. Despite the current market uncertainty, overall 2021 has been a very good year, with the S&P 500 growing by more than 20% year to date. Diversification and portfolio rebalancing are paramount to lock in the profits built over the last year and to build a strong platform for the next year. This was weekly market update as of 5th December 2021. Hope you found it useful and engaging. Tune in every week for news, views, and market moves. Subscribe on YouTube, Apple, or Google Podcasts, or on your favorite podcast app. I'm your host Damodar Mata. Until next week, stay safe, stay invested.